Sometimes people just run what a payment could be on a mortgage calculator online and think, well, I can afford this. This is no problem. But they don't realize that there's certain banks that as soon as they receive your mortgage application, they have an internal scoring system that will rank you as far as what they're willing to lend you.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I am a Level 2 mortgage agent, and I'm joined, as always, by David Warren, owner, Referral Mortgages, Level 2 mortgage agent. How are we doing, David? Go Sens, go. It's playoff time.
I'm all right. We got game 2 tonight, so hopefully we can split a series.
Yes, when you're listening to this tomorrow, hopefully it's not 2-0 Leafs. That's all I'm saying. How are things going, David? We had a big week last week. We're gonna hop right into it because unfortunately we have a condensed show today. Just due to how busy the market is. You know, it's just buzzing.
Nothing to do with a long weekend and work piling up.
Yeah, exactly. Yeah. Everything's just we're just on fire. We just don't have the capacity to do a full show. No, but you had some news just about the Bank of Canada last week. They made their third rate announcement of the year. I think it was third. Might have been fourth. How'd it look?
Yeah, as I'm sure everyone listening to this knows that the Bank of Canada decided to pause any sort of rate changes to their overnight lending rate, which affects Bank Prime, holding it at 2.75. So Bank Prime maintains at 4.95. This was a pause after 7 consecutive rate cuts. And what they kind of commented on is that it was the pause is due to the growing uncertainty over the U.S. tariffs, which could push Canada into a deep recession. Tiff McCallum said the bank is cautious and will act decisively if needed to control inflation or support the economy. So it's the first time since the pandemic the Bank of Canada did not issue a forecast either for the economy and instead offered a couple of scenarios, being an optimistic one where tariffs are withdrawn and GDP stalls, so basically flatlines, and then recovers with inflation hovering around the 2%. And a pessimistic one where global trade war triggers a deep year-long plus Canadian recession and inflation rises again. You know, I think in both scenarios, I think the reason for them not providing an economic forecast is also due to the federal election we have coming up. And, early polls were this past weekend. April 28th is federal election. And we're going to have 2 different platforms. So the Liberals have released their budget for their platform, which runs $130 billion in deficit. I guess $65 billion annualized, but $130 billion in new spending over and above what was already promised by the Liberal Party prior to Mark Carney coming in. So the numbers that I've seen is upwards of $250 billion of spending, which pretty well every economist has indicated that this is going to be inflationary spending and going to push that number up. So I think the Bank of Canada is being cautious on that. And today, Tuesday, the 22nd, that the Conservative Party is releasing their cost budget associated with their platform today. So we're only getting those 2 budgets or cost budgets to their platform a week before the election. And I think that plays into where the Bank of Canada, where Tiff McCallum's able to speak on where the economy is going to go, because it's going to be we're going to see it today. It hasn't been released yet at the time of recording, but we're going to see the Conservative Party's budget probably be drastically different from the Liberal spending and complete polar opposites. So I think that's where they're not able to provide that forecast, because who knows which way the government's going to go and which way the wind's going to blow as far as spending is concerned. So I think once, we have a pause in May and then we'll have another announcement in June, but by then we'll know which federal parties in power will have a bit more clarity around the tariffs and, who the first thing on any, whichever prime minister comes in, new prime minister, that it's going to be their first order of business is going to be, tariffs. And so by that June announcement, there might be a little bit more clarity of a pause or stuff, whether it be a trade war or, spending being announced, et cetera, that will give that clarity for the rest of the year.
Yeah, no, great points. I think last week I was actually Friday. I was at the local soccer pitch with Madden kicking the ball around, and when we were driving back, we passed one of the early voting locations, and there was a lineup out the door. So I think, if nothing else, we're going to see probably one of the largest voter turnouts ever. I would say, if not ever, in this election cycle, which is good to see. I mean, that's a huge part of being in a democracy is being able to vote. Good that everyone exercises that. Canadian Mortgage Trends actually had an article out today, and Scotiabank believes that the Bank of Canada has concluded its rates cutting cycle. So they're forecasting that the overnight rate is going to remain at 2.75 through 2026. So a bit further. I agree with you. I think like the pending election is kind of like the wild card, and they're waiting to see what happens to that before making a more final decision in the next announcement, which I think we said was June, right? Um, so Scotiabank's stance basically contrasts with the other major banks like BMO and National Bank, which anticipate further reductions. The primary reasons for Scotiabank's outlook included inflationary concerns, so persistent inflationary pressures exacerbated by global uncertainties such as the U.S. trade policies. That may compel the Bank of Canada to maintain or even increase rates to manage inflation effectively, as you mentioned. And then the second one was economic growth. So while Canadian GDP growth is projected to be modest, 1.7% in 2025 and 1.5% in 2026, it's not weak enough to necessitate additional monetary stimulus. Other institutions like Oxford Economics share a similar perspective, suggesting limited scope for further easing unless trade tensions diminish. Who knows, David? Who knows? I think things will become clear come May. I'm very interested as well to see what the Conservatives' plan is, because I think you know, that extra, I think you said 123 billion, 125 billion, something like that. Like, where is that going to come from?
130, 130.
Oh, sorry, I was undercutting by a few billion. Yeah, where is that going to come from? Like, we're already in a massive deficit, so make it all make sense. Make it make sense here. Typically when these announcements happen, we get a lot of questions, a lot of people asking. I still have most of my clients are still under the impression that we're in like a lowering rate environment. Like everyone, I still get emails almost daily being like, where are rates at now? Can we get a lower rate, or have rates dropped? So that's kind of the overall sentiment, I think, of the market of buyers and sellers, is that rates are still decreasing and that they're going to get a better rate in 2 months from now, 3 months from now, and we don't really know. Like this is one of the times I would say since we got into the industry where I actually have no clear picture as to where rates are heading. Like it's kind of there's a lot of balls in the air right now. So between the tariffs, trade wars, the election, like it's there's a lot of uncertainty, and that uncertainty in the market always creates kind of like stagnation. Like people are waiting to see what happens before they transact, and this has been going on for almost a year now, maybe 2 years even, to be honest.
Yeah, I think people are still when looking at rates and what to choose for a purchase, for renewal, whatever it may be, it's still that, there's still a big predominant portion going variable to kind of hedge that, kind of seeing where prime ends up going, being that there is so much in flux, but having that ability to convert to a fixed, and then others going, you know, I'd say, it's probably split between a 3 and a 5 year fixed as far as what people are still going. That 3 year is still pretty popular as far as a hedge, like it was even a year and a half ago, 2 years ago. And really, those that did take a 3 year fix 2 years ago, it is still looking like a good hedge, because when they got it, it was in the mid to low sixes, high fives, and we're well below that. We're low fours right now. And so I think, we're going to continue. I think we're going to continue seeing that trend of, probably half going variable and then a split of fixed in on the 3 and 5 year. But yeah, a lot will kind of shake out over the next 30 days.
Yeah, a few things also I wanted to touch on, just from there's been a few comments over the last few episodes just regards to kind of all of this, and we were talking about the promise of so many homes being built, and how that impacts the market. So one of the questions we asked last week was, have you noticed a difference in how stable Ottawa feels compared to other Canadian cities? And Boker of 85 said half of the tradesmen are sitting at home in Ottawa, and Belay just laid off 260 guys last week. So past 2 years, Ottawa has been really stable at going downhill. The last busy site I had was in April of 2022. I'm assuming he works in the trades, obviously. Greg responded to that just saying, yeah, I've heard the same from a few people. I've even heard of drywall company moving operations outside of the city. Nathan G, this was another comment, says, guys, look, as a buyer, I'm paying the whole commission on both sides, indirectly either way. The way you get yourself cut off is to piss me off. Not every buyer is going to result in a sale. Some will and some won't. And some of that is just the market. If the only way you can keep clients is to force everyone to meet and sign a BRA, that was the buyer rep agreement that we talked about a few weeks ago, to try and prevent them from escaping, then you need another line of work. Every single realtor out there can show a home. Every single realtor can fill out the CREA offer forms and copy and paste the clauses. If you're doing your job properly and being realistic with people, buyers and sellers, you won't have trouble keeping clients. If you start trying to charge fees to buyers, there's no reason for most buyers to use your services anymore. So this was in response to us having the conversation when Greg was on about the buyer rep agreement and how on the broker side, we basically don't have that, right? Like we just kind of do all the work up front. And if the file closes, then we're compensated by the lenders. But realtors on the flip side have that buyer rep agreement where when to start working with a realtor, you typically sign an agreement for 60, 90, 120 days saying that you're committed to working with them exclusively during that time frame. And I think Greg was just saying that most of the time he doesn't do that. He just, bases it on relationships and so on. So I think Nathan might have been a bit, I think he might have misunderstood our position on it, because I think we're all in agreement that like that is just the way the industry is. And you have to show your worth, obviously, through your efforts and through your knowledge. So I just thought that was an interesting. I actually like people coming at us a bit, because it allows us to kind of defend our position, or at least clarify our position, because oftentimes, we say one thing and people hear another just because of the, maybe we say with jargon or with some bias, or maybe just that additional experience. So it's always good to have that feedback. And Greg did respond to that. So if anyone's listening to this, you want to hear Greg's response, you can go to our YouTube channel. But any feedback on the Dave? Have you heard anything about like on the trade side of things, or just in that regard? I find that very interesting that these construction companies are laying people off currently when we're in such a huge hole, right? As far as new builds, new construction.
Yeah, I mean, around Ottawa, there are a number of obviously cranes up and projects underway. There are a number that have stalled, or that are in receivership even, though. But they're, from where we were to that gentleman's comment of 2022, I mean, people aren't moving. They're not refinancing to do renovations or additions. And so when you have a slow resale market, then the trades, like the home renovation companies, are going to be affected. They're not going to, when people move, they're hiring tradespeople to, from I'm talking about residential construction right now, but they're, people moving. The market's busy in 2022. The market was busy for resale, and so people are doing additions as they're moving in, or they're doing additions or renovations to sell their house or list it. So that's a busy market when there's a lot of transactions going on, because that's when people are refreshing their house to sell for top dollar, or they're moving into a house and doing renovations to get it up to where they want it to be when they move in. So that's a whole segment that's basically been relieved, because we don't have the resale transactions. Like we're averaging like there's a 900, 1,000 units being sold right now, which is very, depressed versus where we were. And then, and that's just on that side of things, without getting even into the condo, builds or new builds. Obviously builders have basically, put a halt on building. We talked about last week that housing starts are drastically lower than where they're supposed to be, or projected to be. And I think we're seeing that in the condo market and all that, where cost of construction for acquisition is expensive, holding costs for that period of time, and then they're just not moving as far as resale. So builders are sitting on these properties, and they have these plans to build, but they're not building right now because there's no exit right now, because the market isn't moving enough for them to be able to unload those properties. And so why start that project if you can't unload it and there's no exit strategy? It's the same as, when we're looking at a mortgage file for a client that's maybe has bruce credit, or, or new income, and we're having to go the alternative lending route. We look at that exit strategy. Well, what steps are needed to get you to a traditional bank? And that's get your credit up, pay these debts off, or, tenure with this job, or tenure with this, your new employment job. And it's the same idea for these developers. Like they're looking at what's my exit strategy, get out of this financing. They're on construction financing, or they're self-financing even, which is just opportunity cost with where that money could be. And they're
Right.
left holding that project. So I think we're not going to see the pickup of the market until rates have come down, or until the resale market's picked up back to at least the 10-year average. And then you're going to have those home renovation companies busier. And on the condo side, really until that resale market is picked up, I don't foresee them really like starting those projects too quickly.
Yeah, that's a very good point that I hadn't really considered. Like you said, like when people are buying or selling, especially selling, I find people are doing like those small upgrades. I know the last two homes I sold, I did, kind of kitchen updates prior to listing just to get that kind of top dollar. And the flip side of that too is that all those, like when there's an abundance of extra money, when we're not pushing on a recession, and people have money to spend, like that's when they consider like, oh, we have an extra 15,000. What should we do? Well, let's update the flooring. Let's add that addition on the house. Let's do whatever, right? All those projects are not happening because everyone's dollar is being stretched thin.
Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Geltin Poirier Avocat Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at geltinpoirierlaw.ca. Let's get to the heart of your deal. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big. Protect what matters most.
There was another comment here that kind of ties into this. It says, how are we going to increase housing starts if many tradesmen in the city are averaging in their 50s in age? Would be curious to find out if there are more retiring than being hired in the city on an annual basis, or if we are closely approaching that point. So something I wanted to touch on too that I thought was pretty neat is that the Conservatives in their proposed initiatives is aimed at increasing the number of skilled tradespeople through grants and education. So they have a more boots, less suits plan, which includes reinstating apprenticeship grants of up to $4,000 and expanding training halls to train 350,000 workers over the next 5 years, promoting trades education in high schools. And additionally, they plan to require banks to recognize apprenticeships for registered education savings plans, ensuring that all related expenses qualify for education assistance payments. So I think that is the way we need to go. Like if we need boots on the ground, right? Hey, more boots, less suits. Then we need initiatives like this that are going to entice people to even consider going into that field. Like if there's no jobs available and people don't have the experience, then they're going to go into other careers. It's just reality of it. But I think if they do start introducing it in high schools and say this is a career path that you can take, here's the roadmap, and here's grants to assist you with that, then I think that's a step in the right direction as far as creating that workforce, right, to build these homes.
Mhm. Yeah, the over time for a period of time there's been such a push for people through high school and go to high school, go to university. Now it's a push to, software engineer or computer programming or whatever it may be, because of where those, that has been kind of the push in the fields, but not as much of a push in the trades area, like you mentioned. And certainly to that gentleman's point, that aging, I don't know the statistics of, people aging in that realm, but I would imagine exactly as you said that it is probably an aging demographic in that field, and hopefully more go into that area of expertise in that those industries that can learn off the elder statesmen before they retire or move on, and kind of help with replacing. But certainly, if there's no work and there's no incentives for people to go into those fields, and they're just not going to, and so it's kind of there's a couple areas there. I mean, we need there needs to be a turnaround in the market in different areas, and not just resale, but just from a development and for even, like I said, the home and not just be government spending on like infrastructure. That's obviously going there's when you have infrastructure builds like that, obviously needs those skilled people as well. But I think on that home and condo build, it'll be a little bit before both those markets start really picking up where that turns around. But I mean, we're talking 2022 as far as being packed job sites, and that was a very short period of time ago. And so hopefully in less amount of time than that we also then have the reverse, and we're back. Right now it's stagnant or dipping, like you're saying, but hopefully in short order that we'll have that demand back up or those sites back up.
So here's the last question of the day, and then we'll slide into some mood boosts here. So Dick Wong says, I have a friend that's been talking about buying a home for years. I told her the first thing to do is go talk to a mortgage broker to see how much she'd be qualified for. Instead, she's gone and seen a few open houses. That's usually the way it goes. Finally, she went and got her numbers ran, and she can't qualify for anything she wants. She's also not the first person I know to have done this. I kind of just wonder if it's that people think they can afford more than what's realistic, or if it's just a matter of them wanting to do the fun thing, aka look at houses, and delay the boring thing, aka paperwork. And I'm also curious, since you guys mention it every week, what's the difference between a level 1 and a level 2 mortgage agent?
Great questions all around, and I always joke that the going to look at houses is the fun part, the shiny thing, and that's what everyone wants to do. So it
Well,
doesn't
you don't want
surprise
a
me at
brand
all.
new shiny mortgage, David?
Yeah, you don't want some shiny new debt.
Yeah.
Um, nobody cares. Nobody wants to talk about their finances. In some cases, it's also intimidating to look at their credit, to look at what they qualify for, and it's more fun to look at the possibility of what they could get.
Mhm.
We always say to people before going and looking at anything, have your numbers run, get pre-approved, gives you a roadmap, gives you confidence to know that what you're going and looking at is something within your budget. Because otherwise, it's almost like what that woman's doing is looking at things that are outside of that budget, and it's just going to sour the process at a later date as well. Because you're looking at
Well, then you get
places that are
excited.
you're looking
Yeah.
at $5 million places, when really should be looking at $500,000 places. It's going to be a big difference in type of property you're getting, and so it's also going to kind of skew that process. So getting pre-approved early is really just, knowing where your budget's at, setting that roadmap. And again, so you can get out shopping with confidence, have your searches more refined as far as, within those guidelines. And yeah, sometimes people just run what a payment could be on a mortgage calculator online and think, well, I can afford this. This is no problem. But they don't realize that, some of the income that they're trying to consider that they're planning to use for that can't be used from a mortgage qualifying perspective, or they just don't qualify because of XYZ of the type of income they make, or it's a new employment or probation and they need, different exceptions, or that credit is depressed. They've got some bruised credit, which is pushing them into a different bracket as far as what they qualify for. Because what some people don't realize as well is that there's certain banks that as soon as they receive your mortgage application, they have an internal scoring system that will rank you as far as what they're willing to lend you, regardless of what your qualifying ratios are. They will purposefully reduce that ratio or that loan to value because of where, maybe you have missed payments with that institution or your credit is this or maybe, but they do have those internal rankings.
You're a flight risk. Yeah.
Yeah. So it's, that's also something that people don't realize. Like they just look at those qualifying and they don't know the back end of it. So absolutely, we always say get pre-approved, get qualified, know that roadmap. Um, and then I think what was the other question or what was the other question on that? I
The
forget.
level 1, level 2 mortgage agents.
Pretty dumb and confusing thing that the regulators brought in. But basically, a level 1 mortgage agent can only deal with A banks or prime banks. This is like your, big six, credit unions, that sort of thing. Level 2 agents should probably be the other way around, but level 2 agents are able to deal with all types of lenders. So this is not just your primary banks, but also your alternative lenders or, B lenders, your mix. And these are mortgage investment corporations or private lenders. And so it gives them more tools in that toolkit as opposed to a level 1, which is restricted to those kind of more regulated prime banks, if you will.
Yeah, they should really have it. Like even like clients ask, I've had clients ask me like, "Oh, how come you're not a level 1?" It's like, "Oh, well, level 2 is actually the higher of the 2 levels." Like it should just be kind of like standard license, maybe like advanced license, or I don't know, something to make it clear to the public. Like I can't imagine anyone who's outside of the industry has any concept of what either of them means.
No,
So
it was the
great
dumbest thing
question,
that they
and
brought in. It's the
yeah,
dumbest thing that FISRA brought in, like, or an OSFI 2 years ago now. We're in
well,
the
the
second
names.
full
I think
cycle.
having the different licenses is smart, but the names could definitely be. They should have gotten to the whiteboard maybe for a bit longer. As far as
Those,
brainstorming.
yeah, for those going for a level 2, kind of just to wrap it up, but they do need to go through additional training, additional courses to understand and be able to evaluate alternative lending and private lending better and be able to ensure that they understand that market, because obviously it's higher interest rates, higher fees, more creative financing. And so it's so that the individual that's ever recommending that is educated on that properly. So it's not just your traditional relicensing course that we have to do. Paul, should we slide in some mood boosts? This went a full episode long.
Yeah. We'll keep it short today. Only 30 minutes. Yeah, I got 3 today. Number 1, never trust someone with graph paper. They're always plotting something.
Uh-huh. I
A lot
like
of
that.
plotting. Number 2, I start a new job in Seoul next week. I hope it's going to be a good career move.
Oh, wow. Wow.
And number 3, which country's capital is the fastest growing? Ireland. Every year it's Dublin.
Oh. Wow.
Thank
Wow.
you.
You
Got that
bookended
from
that.
the old dad jokes book.
You bookended that.
I did. Yeah, it was good.
I liked
good.
the first and the third.
Yeah? You don't like my career move? All right, everyone. Thank you to our amazing sponsors, as always. Gerté Poirier Avocat Lawyers, amazing real estate and will and estate lawyers, and also Big Insurance in Westboro, and last but not least, Centum. Thank you all for your support, and thank you for listening. We'll be back next week. We record every Tuesday. Episodes are released Wednesday at 10 a.m., and be sure to follow us on all of our socials for exclusive content and shorts. We'll see you then. Go Sens go. Leafs suck. We'll see you next week.
Deuces.